Okay, well, it's 3:30, so why don't we get started? So welcome to our panel discussion on how to thrive in the coming recovery. I'm David Frankel, Managing Director of Pelham Associates, and I'm also a professor of economics at Melbourne Business School. This panel discussion has a live audience. Audience members who have questions are asked to please submit them in writing using the Zoom chat function. And then our moderator, Monette, will read them at the end for the panelists to answer. So the impetus for this workshop is that we've had some promising vaccine results lately, as well as some strong economic numbers. Economic output in Australia fell by 7% in the second quarter of 2020, but then it rose by 3.3% in the third quarter. So we're already in a kind of recovery, and it's expected to continue. The RBA's baseline scenario predicts GDP to grow by 5% in 2021, and then by 4% in 2022. The unemployment rate, which was 6.7% in October 2020, is projected to fall gradually over the next couple of years to just above 6%. Inflation, which fell to minus 0.3% in the second quarter of 2020, is expected to grow slightly to a still low 1.5% by the end of 2022. And it's important to note that the RBA's projections do not take into account the good vaccine news that we've seen recently. If the vaccines can be deployed quickly, the recovery may happen even faster than the RBA has predicted. Our major trading partners are also expected to recover in 2021. China's growth, which fell from 6.1% in 2019 to only 1.8% in 2020, is expected to rise to 8% in 2021. And world trade, after shrinking 10.3% in 2020, is expected to grow by about 4% in each of the next 2 years. So today, Pelham Associates has brought together 4 of its leading experts to discuss the ways in which managers can take advantage of these changes and thrive rather than being left behind. Our first guest is Brent Coker, who is a researcher and lecturer in marketing at the Faculty of Business and Economics at the University of Melbourne. Brent's specialty is consumer behavior and psychology, with an emphasis on online behavior. Brent is also a management consultant and expert witness. In particular, he's helped Qantas and IBM with their branding and digital marketing, and he's also testified in the federal courts on these and related topics. Brent, welcome, and thanks for coming.
Thanks for having me, David.
Brent, you've recently looked at the 2003 SARS epidemic in China in order to predict how consumer behavior may change after the current pandemic ends. What have you found?
Yeah, so we're looking at patterns on what happens in industry in certain markets. One of the markets we noticed that changed quite significantly was the physical fitness and gym memberships. So we thought this was something to do with a phenomenon in psychology called priming. We see that with consumer psychology quite a lot. How that works is when somebody is exposed to a certain idea over a period of time, it kind of sticks in their mind. And since there was so much information through news channels and obviously all around people during the SARS epidemic, people started to think about their health. And so what happened was that there were more gym memberships and sports club memberships after SARS than there would have otherwise been if SARS hadn't happened.
Oh, that's very interesting. Okay. What else did you find in your research?
So there were a few things. One thing that's, I guess, kind of interesting is the alcohol cigarettes. So I know that's not in the notes, but the alcohol cigarettes, for example. So one thing you might expect is that alcohol consumption would increase during recessions or hard times, certainly during lockdowns. And what they found during the SARS epidemic is that alcohol consumption increased afterwards when the economy swang back. So, that's kind of one surprising finding. It kind of suggests that people drink to celebrate more than they drink to drown their sorrows, kind of
maybe
thing.
Maybe drinking socially, like they had an opportunity to drink socially again.
Absolutely,
that makes
yeah,
sense.
that's right. And once people were allowed out again, they had a lot more fun.
Okay. Anything else do you want to share with us?
Yeah, I guess marriages, births and marriages is one thing that we think will be affected by this. Given the state of the economy, we tend to see an upswing in marriages and births. I guess the marriages one is a little obvious. People are in lockdown and there's restrictions on how many people they can have at their wedding. And so they tend to put that off until later on when the rules are relaxed. So we will see a spike in marriages, but also births. And one thing we saw, for example, World War II was associated with a kind of a depression as well. And there was of course, the baby boomer generation that came out of that. And so we are expecting, we saw a little spike in this when the SARS epidemic ended as well in births, which is an interesting one.
I see. So that could be good news for, let's say, hotels that have event complexes where they can put on weddings, that type of thing. And also for companies that sell or retail any kind of baby products. I guess they can be fairly optimistic.
Yeah, that's right. I mean, it's a new generation. We're on Generation Z at the moment. Maybe the next generation is going to be called the COVID generation. Who knows?
Corona babies?
Corona babies. That's it.
I saw you use that term. What about, also, I noticed that you mentioned in your work demand for household cleaning products, which I thought was kind of surprising. So what happened there?
Yeah, so household cleaning products, again, I think it's related to this idea of sensitization. So people have become used to cleanliness now because of the pandemic. Certainly they witnessed that in Hong Kong and China at the end of SARS, a large spike in cleaning products. And that tends to endure after the pandemic is controlled, which suggests, some kind of habitual, ongoing kind of a thing where people are used to being clean and they'll continue to be clean even though the threat has passed.
I see. So people become more germophobic in a
yeah, well,
public health
it
crisis.
might not be that. It might not be that. It might just be habits. We know that a lot of trends are driven by habits. Essentially, once people get used to doing certain things. The other one was cooking appliances. During the SARS epidemic, people were in lockdowns similar to what we've experienced recently. And there was a big spike in household cooking products simply because people taught themselves out of necessity, really, to cook themselves rather than go out and eat. And I think we've seen a little bit of that in Australia as well, based on some of the data I've seen.
And so would you expect all of that particular demand to end when the crisis ends?
It doesn't seem to be. I've looked at some data more recently, and it seems that one thing that happens is people take up new hobbies as well. And I guess if cooking's classified as a hobby, people tend to stick with it over time. Another interesting industry that increased was the home brewing industry, as people that don't necessarily need to brew their own alcohol. There's no restrictions on going out and buying your own. However, it's classified as a hobby, and that was one that saw a big spike in sales around Australia.
Wow, that's really interesting. Well, thanks so much, Brent, for those pieces of information. That's really, really very interesting. So we're going to move on now to our next guest, who's Deshani Ganegoda, who is an associate professor of management at Melbourne Business School, where she teaches managing people and negotiation in the MBA program. Deshani's research centers on business ethics, organizational justice, negotiation, and workplace deviance. She's also worked with many private companies, including Target, Boeing, and Disney. Welcome, Deshani, and thanks for being here.
Thanks, David. Happy to be here.
So, Deshani, over the next few months, the job market will likely start to improve. What new challenges and opportunities do you think this will pose for employers?
That's a good question, David. We've all had to adjust to new ways of doing things in the last few months, especially here in Melbourne. So in the next few months, as the businesses start to open, one of the key things that managers will have to decide on is which aspects of remote working should potentially continue post the COVID crisis. For example, research shows that flexibility and autonomy at work increase employee satisfaction and reduce employee turnover. Some companies have known this for a really long time, and they've had practices in line with these philosophies. But others may have had to go through a forced experiment in the last few months. And they may have received some surprisingly positive outcomes from this COVID experience. So the question for them is, to what extent are they going to stick with those remote working conditions post this lockdown period? Okay. Now, the challenge for managers would be to figure out how to keep employees committed and engaged in a remote working environment going into the future.
Interesting. So how exactly can managers do this?
Yeah, so the traditional command and control management style is not going to work when you can't really see your employees on a day-to-day basis in close proximity.
Could I just interrupt you and ask you to explain what you mean by command and control?
Yeah, absolutely. So command and control is where you have systems such as clock in, clock out, and where you keep a close eye on your employees and track all of their movements.
Okay.
It's very sort of authoritarian management style, which doesn't work when your employees are dispersed over many areas and you don't really see them on a daily basis, but still the work needs to happen. So if that's the situation, then we need to think about other ways of managing people. So some of these other ways, alternative methods would be things such as goal setting and developing a strong organizational culture where you impose strong norms around certain work behaviors and standards of work quality.
Okay, so how can managers establish these norms? And maybe could you give us an example of a norm that a manager might want to establish?
Yeah, so norms are, as I said, established through an organization's culture. So one way of doing that is through the selection process. So try and find employees and recruit the employees who have the values that are in line with your company's values.
Well, what would be an example, so we can have, fix this in our mind, what would be an example of a value that you might want to screen your job applicants on?
Yeah. So one of the things that I can tell you is in terms of, we talk about customer-centric organizations, how customer service is an important quality of organizations. Okay. So companies such as Neiman Marcus, Ritz-Carlton, for example, they recruit employees that have that kind of values. For example, do they have empathy? Can they relate to other people? What kind of interpersonal skills do they have? So if customer-centric behavior is critical for your organization, then you have to select people who have those qualities.
I see.
And of course, you have to orient them to the company's culture, as well as have senior people role model the appropriate behaviors and provide mentorship.
What about mentoring? Do you think that might play a role?
Absolutely. So senior employees as well as leadership, they have an important job in doing these things, especially in terms of imposing those values in a core company's culture. When you can't hang over your employees and tell them exactly what to do step by step, it's important that you align the values of employees with the company's values so they know how to behave in an uncertain situation when the managers are not always near them throughout the entire day.
I see. Okay. That sounds really interesting. So I see you've also done some work on employees who are overqualified. And I wondered if you could tell us a bit about that and why it might be particularly relevant in the present situation.
Sure. So in a recession, it is likely that unemployed workers would accept jobs for which they're overqualified. From an employer's point of view, it is important to know how best to manage overqualified employees in situations such as these. So what our research shows is that managers who display humility are better positioned to get the best value out of overqualified employees.
Oh, it's really interesting. Do you have any idea why that is?
Yeah, so what we find is that humble leaders have the capacity to affirm employees' self-image as overqualified or highly qualified employees. So through this affirmation, they get a sense of pride, a sense of confidence that then empowers them to ask a question or raise a concern, or if they have a great idea, to say it out in public in a way that it benefits the organization.
I see. Interesting. So I guess that suggests that if you hire an overqualified employee, you should be careful to assign them to a humble supervisor.
Absolutely. You get the best value out of that overqualified employee if you match that employee with a manager who displays that humility and doesn't feel threatened by an overqualified person and allows that overqualified employee to do their maximum capacity at work.
Okay, that makes a lot of sense. Well, thanks a lot, Deshani, for helping us understand these very important issues.
Pleasure.
Our next guest is Bruce Grundy, who is a professor of finance at the Faculty of Business and Economics at the University of Melbourne. Bruce received his doctorate at the University of Chicago and taught at Stanford and Wharton Business School before returning to Australia. An accomplished researcher, expert witness, and consultant, Bruce has worked on projects for Clayton Utz, Minter Ellison, Cooper Grace Ward, Telstra, Alcoa, and BHP. Bruce, welcome and thanks for coming.
Good to be here. Happy to see everyone.
So Bruce, one result of an economic expansion is that companies will want to make new investments. In many cases, they won't have enough cash on hand, so they'll have to obtain financing. How do companies generally do this?
Well, natural way would be to borrow from a bank, but if the company is larger, it might issue bonds to investors or issue shares to investors.
Ah, okay. So when they sell bonds, that's similar to a bank loan, isn't that right?
Yes, they're similar in the sense that the borrowing company commits to make a series of repayments through time to repay the loan, as well as interest on any outstanding amount of the loan. So there's a fixed schedule of repayments on both bank debt or a loan, a public bond.
Okay, all right. So I guess that's why both bonds and bank loans are two different, thought of as two different forms of debt. What about shares? Are those also a form of debt?
No, how they're different is that there's no fixed schedule of repayment. In fact, there's no due date when the money invested by shareholders has to be given back to them. And the income payments that take the form of dividends, there's no fixed schedule there. They could be high or low. Because the company's under the control of the shareholders, the shareholders themselves determine whether they want to receive money back from the company when it's profitable or leave the money invested in the company.
I see. Okay, that makes sense. Thanks for explaining that.
So the shares are equity,
okay.
equity financing as opposed to the debt financing from a bond or a bank loan.
Okay, great. That's a very useful categorization. So I understand that you've recently studied the financing choices of companies and found some interesting results.
Oh, yes. I have a recent study with a colleague from Erasmus, and one of the results we found was that if the new investment is going to mean acquiring assets that are both tangible and non-unique, so these two specific terms, it's more likely to be financed through a debt issue.
Okay, so it sounds like there's a lot to unpack here. I wonder if you could explain to us what you mean by tangible and non-unique.
Yeah, tangible is pretty familiar. It's some form of physical asset. It's not something intangible like goodwill. So that makes sense that there is an asset there. You can physically seize it. What's important is whether that physical asset is non-unique. Is it unique to the company, or could anyone else use it? That's going to be quite important. So if a Toyota Corolla car owned by a rental car company, that car is hardly unique to the rental car company. Some other rental car company could acquire it and rent it out. It could be sold and someone could buy it for their kids and their kids could drive it. And anyone else could acquire ownership of that car and get use out of it.
That's interesting. As someone who had bought a former rental car, I know exactly what you mean. But I wondered if you could also explain to us what's an example of a unique tangible asset.
Well, sticking with the Toyotas and Corollas example, you'd think of the assembly line that makes a Corolla. To the extent that line is probably being transformed to be specific to the controller, to the Corolla, it's going to be expensive to convert it to produce another car, really expensive to use it to produce anything else. It's going to have very little value if Toyota's current market collapses. So the assembly line that's got there, it's only going to have value as scrap.
Okay.
It's unique. An assembly line to make Corollas is unique to Corolla.
I see. I think I understand now. But what do tangibility and non-uniqueness have to do with the choice of a company's financing?
Well, the lenders naturally want to get their money back. There's a fixed schedule of repayments. If there's a default because the company's not doing well, but the assets can be seized and resold, then the borrowers have security the lender has security for the loan. The lender can lend the money. It's invested in something that's tangible that could be seized, that could then be sold to someone else because it's not unique to the person who you just seized it off. So there's a market for it. So you can lend money to the company because they're going to invest it in such a way that even if the company does poorly, you can get something back. You can get the asset back and sell it to someone else.
Okay. I think I understand. So for instance, if Google defaults, there's nothing for lenders to seize since Google doesn't have much in the way of tangible assets. If Toyota defaults, lenders could seize its assembly lines, but they can't resell them very easily because the assembly lines are unique. So in either case, lenders are out of luck. On the other hand, if a car rental company defaults, lenders can just seize and resell its fleet, which does let them at least partially recover their losses. Is that correct?
Yep. The lack of cars in Tasmania today is telling you that if a rental car company defaulted, their cars would immediately go to Tasmania.
Okay. Very interesting. Have you tried to reserve a car in Tasmania?
No, just watching the news over the last 24 hours.
Okay. All right. So that suggests that, bringing it back to financing, that car rental companies are more likely to use debt, while Google and Toyota are more likely to use equity. Is that right?
Absolutely.
Okay, that's very interesting. Okay. Could you tell us a bit more about what your research shows?
Yes, another thing that the study with my colleague found was the financing of investments that could be characterized as hit or miss investments.
Okay.
That's quite
what
interesting.
Are those?
Well, basically it's a hit or a miss. So if there's a miss, there's a really high chance that nothing works, there's a zero payoff. But when it works, it's wonderful. There's a huge payment. So you want to think of it as a one of two types. You get nothing or you get a lot.
I see. So what would be an example of that?
Well, given the topic of today's conversation, a vaccine against COVID. If you've got one that works and you get it early, your business is in heaven. If you've got one late or you've got one that doesn't work or you never get one, you've got a zero payoff.
Okay.
So
I think that's a great example.
In all the research and development, a huge expensive investment could be characterized as a hit or miss investment.
I see. That sounds like a really good example. So if a company has a hit or miss investment, how is it likely to fund that investment?
Well, it's much more likely to be funded through other bank loans or selling shares. It's very unlikely that it's funded by selling bonds.
Oh, that's very interesting. So why do you think that is?
Well, again, it comes down to a potential lender, a buyer of those bonds, is really concerned about a risk of default. And if there's a high chance of the miss, there's a high chance of default. Well, if it's a research and development thing like COVID, and there's a whole series of stages, if it doesn't work, then the company that's got the money will just keep trying. There's some chance it'll pay off, and they'll keep researching until they've used up all the capital. They're not going to turn around and say, oh, well, this isn't working. Here, have your money back, lenders. You can take this now.
I see. But isn't the same thing true of a bank loan?
Yes, but banks are going to generally be much more closely linked to the company and much better monitor of how the research is going than how many small bondholders would be. They can't really evaluate how a particular drug company's research is going. The bank that lends to the drug companies will be requiring that the drug company give them reports on how the research is going, and the bank can give them enough money to undertake each stage of the research separately. So with staged financing, the first stage, if that's a success, the bank will lend to them again enough for the second stage. And if that's a success, they'll lend again. But if the second stage doesn't work, the bank is going to be very loath to provide money to, oh, you can try a second stage again, here's some more money.
Okay. All right, that's very interesting. I think I've learned a lot from our conversation. Thanks so much for your insights, Bruce. So
thank you.
Our next panelist is Gerardo Berbeglia, who is an associate professor at Melbourne Business School. Gerardo specializes in operations management and data analytics. Gerardo's research interests include revenue management, pricing optimization, and consumer behavior under social influence. He has also worked as a consultant on revenue management problems, designing pricing algorithms for Air Canada and Thalys, which is a Belgian high-speed train operator. Gerardo, welcome and thanks for coming.
Thanks, David. Pleased to be here.
So, Gerardo, I was hoping that you could help us out here because, as Brent Coker pointed out earlier, the pandemic and the recovery are likely to cause changes in the types of goods and services that our consumers and clients demand. In addition, if, as we expect, the recovery is brisk, these changes could come quickly.
Yeah, I mean, one of the examples of this huge change is the impressive increase in online sales, which are very likely to stay after the pandemic, but still they represent just 15% of the total sales in Australia, approximately that.
I see. And so what does this imply for managers?
Well, what it means is that whenever customers' preferences change, the firms need to readjust what they are offered to them in terms of products and services in order to maximize the revenue.
You mean this assortment of products and services that they feature on their website?
Feature on the website or in the store, or even the ranking of the products, like the way they are displayed on the website, etc. Yeah.
I see. That's a very good point. So how can companies do this?
Well, that's an interesting question. So they need to actually infer or deduce what are the consumer preferences. And because of all these changes due to the pandemic and changes in consumer behavior, some of them already mentioned before by the panel, previous data points and previous transactional data might not be as valuable as they used to be.
I see. So how can companies gather new data? Would they be using
transactions?
Sorry, go ahead.
Yeah. So they will need to use actually transactions from the past months, for example, and try to analyze well that information and try to use data analytics tools to deduce the consumer preferences.
I see.
They can also do surveys as well. I mean, you can do surveys and you can deduce some preference over there.
Oh, that's interesting. Because I mean, there are obviously some types of companies that don't have a lot of transaction data, right? I guess an example might be a law firm that, in which the transactions don't happen on the website, basically. So they would be able to survey their clients.
Exactly. Yeah.
Right. That's a good point. Okay. So let's say a company has somehow collected this data. Should it then just feature the products that have been selling well?
Well, that seems like to be like a good intuition, but in fact, this could be quite wrong in the sense that when you actually take a look at the products that sell the most, maybe they are not the most profitable ones for the company in terms of the markup price, and they might be cannibalizing other products that are much more profitable. Right? So we have to be very careful about which products to show to customers.
So what does it mean when one product cannibalizes another?
So it could be that, for example, you show one product, and because you show this product, that product is actually reducing the sales of another product that it was already offered by the company. Right? So it all depends on the consumer preferences. And particularly after a recession, when consumer preferences change, products that were not cannibalizing another, they might start to cannibalize another, right? So for example, in good times, a cheap version of a product is not cannibalizing the more expensive product that you're offering. But when after a crisis and people learn and then there's less income, that product that is at a lower price is actually cannibalizing the higher margin product, right? So, the firms need to be aware of this and maybe readjust their products and services in order not to have this such big cannibalization of the different products.
Ah, I see. Okay, that makes a lot of sense, and it's not something that I would have thought of. Is there anything else a company can do to maximize its profits?
Well, they need to as well try to find a way not only to show the best assortment or the best assortment of products or services, but also the way to show them in a website, and they can also do more customized assortments for different consumers they have. Right, so that's very easy in an online platform. Customers come in, they might know a lot of information from that customer. They might know the age, the location. They might have like previous transactional data if they already bought at that site. And depending on the type of customer, they should show different products and different order of the products in order to maximize the profit.
So when I surf a website, so, the website knows my age and location?
They might know that, yes. So they have a good estimate of that. And there are some marketing companies that, thanks to the use of cookies, they can learn that. So one example that was known a couple of years ago is that, for example, it has been shown that Expedia shows different hotels to different people, right? So it turns out that if you are a Mac user, you will see more expensive hotels than if you are a Windows user, even if you go to the same website.
I'm glad I have Windows then. That's interesting. Is there anything else that's been on your mind lately?
Well, going back to this idea of displaying, many companies actually display products by popularity. So it's kind of this thing similar to what you're saying, that just show the ones that sell the most. But it turns out that this could be a bad thing, because there is kind of a self-fulfilling prophecy there. If you are one of these more popular news, for example, in BBC News and many journals, they display by the most popular articles. If someone is at the top, people still clicking the one at the top, and this creates something that is well, the richer get richer effect. And in that sense, companies should actually randomize more and try to explore more different ways to try to show to customers what they really like, rather than just the most popular ones, which create this issue.
Oh, I see. So like if a company has a new news story or a new item and they put it at the top of the list, it'll tend to get more clicks and so stay at the top, but it's just because they put it at the top to begin with. It's not because it's really a more appealing product.
Exactly.
I see. Okay, that's really interesting.
Right. So we have developed, so there are some methodologies that actually can figure out what is the best ranking of products to show to customers in order to maximize, for example, the revenue, or if you want to maximize the amount of clicks in terms of the newspaper, etc. So there are a few algorithms that can help do that much better than just sorting by popularity.
I see. And is that something that you work on in your research?
Yeah, indeed. Yes, I do a lot of ranking optimization, what is known as.
Okay. All right. That's very interesting. All right. Well, Gerardo, thanks so much for sharing your thoughts. And it's now time for questions.
Thanks for being here.
Oh, and it looks like there have not been any questions. So would anybody like to break in now and ask questions? Any of our audience members, you're welcome to unmute your mic and ask a question. Okay, well, I guess that's good news because it means everything was incredibly clear. So, so in closing, I'd like to thank our panelists for coming today to discuss their research. And I'd also like to thank our audience members for participating. And finally, I'd like to thank Monette for helping moderate. This ends our workshop on how to thrive in the coming recovery. Good luck, everyone.
Thanks, David.
Thank you.
David.
Thanks for coming.
Bye.
Good to see you all again.
Thank you very much.
Thank you.